Let's continue our bond talk here after a slightly warmer than expected inflation print this morning. Hasn't done anything to derail treasuries, which are firmer on the day. Tracy Chen is a portfolio manager and head of structured credit at Brandywine Global. Tracy, welcome back to the show. From our conversations, I know that your team is looking for this kind of slow and steady reflation trade that has been now kind of forwarded maybe a little bit by vaccines. What do you make of the data that we've gotten over the last month here in terms of the economy and what it's signaling about potential for reflation?
Yes. Hi, Oliver. Thanks for having me. So our take is that we might go through a dark winter, and because we see the coronavirus cases increasing and death number increasing. But as an investor, we should look beyond this dark period, and because the reinflation trade will still continue next year. So at the moment, we see the recent number has been a little weak, especially on the job front. But as a result, we do think that the stimulus package, which is still in discussion, is very important. But at the same time, we think if the deal cannot be reached this year, it should be early next year. And also with the vaccine development, we do think the reflation and recovery trade should continue.
Tracy, what will be the determinant if recovery does lead to reflation or inflation? Do we need to have some shock of some form? Do you think that investors can kind of understand the pace and see it as a manageable one based on what we know right now, that people are going to start getting vaccinated? We might have this kind of dark winter in which activity is slowed. It seems like everybody agrees on the plan right now, Tracy, but what could derail it? What could surprise us?
There are a lot of things that can derail it, actually. The deployment of the vaccine and the efficacy of the vaccine, which is still not yet proved in real life in large numbers. And we also see a lot of stories talking about the allergy. People have allergies, may have some reaction to this vaccine. So there are a lot of risks out there. But at the same time, I think the fundamentals will improve because there are so much stimulus in the system and so much liquidity. And the stimulus package has been unprecedented, especially in the U.S. and in other countries. I would say this is a synchronized easing across the globe via fiscal and also via the central bank monetary policy. So I think that force is very powerful. But at the same time, as an investor, we should look at some of the risks and be cautious.
Tracy, one of the things that's been kind of the hallmark of these last couple of years from central banks is the negative yielding debt around the world, and we're right back to our all-time highs in this. It seemed like we were moving past it as we saw strength in the economy pre-COVID. It looked like maybe that was behind us, but then this pandemic puts us right back in that situation. What's interesting is we're not kind of making new highs on that chart for negative yielding debt. We're basically where we were at the previous high. I mean, if the pandemic here and this collapse of activity hasn't forced an even more extreme blowout in negative yielding debt, do you think this is going to be another moment where we say, okay, that was the peak again?
Yeah, it's interesting. I think with the amount of stimulus in the system, it's not surprised to see the amount of negative yield bonds has been reaching the record high. That just proves a point that we might be in another credit cycle, because at the beginning of this year, we realized we are late in the credit cycle, so we can position defensively. But at this point, we think we are potentially entering a new credit cycle. So investors should be more aggressive in terms of position for the new recovery.
In terms of position, what to you looks like the best way to do that? We've seen since the low, we're looking at the chart right now of just a couple of the ETFs, high yield versus investment grade. High yield has been the bigger winner. We've seen obviously in the stock market too some of this optimism. Is this going to be the trend going forward? Is risk the way to go?
I would say yes. I think the way to play this is to do the rotational trade, because right now the higher quality credit has been resumed historical high, like IG corporate. Some of the IG corporate has negative yield. So as a result, you can see there is a rotation going on. Like the stock market, you rotate from growth to value. And in the credit market, you can rotate from higher quality to lower quality. Especially in the structured credit, you can rotate from top of the capital structure to like mezzanine or bottom part of the capital structure. But at the same time, the risk is more idiosyncratic. But there are definitely some laggards, like the commercial real estate market, some lodging sector, and retail sector, or more cyclical sector, and more idiosyncratic, more complex structure like the CLO, double B and single B. All those laggards will catch up next year. So that's the way to play it.
I noticed that in terms of some of the beaten down sectors, lodging, retail, transportation, your team likes those sectors. But if you go towards kind of you phrase as the benchmark names, I think that's interesting. You're saying, look, if you want to get risk, you can go to that area, but really go for brands, I'm guessing, and entities that don't have any risk or that can buy up weaker ones or over time if it does stay depressed.
Right. Yeah, there's winners and losers in those sectors, and I would imagine there will be more consolidation. Those sectors will be more concentrated with fewer bigger players. Especially if you look at the restaurant sector, there will be a lot of mom and pop restaurants go bankrupt, and then the bigger chain will have better position.
One of the other areas that I see you like is subprime autos, and I'm curious to get kind of the walkthrough on risks here. We've seen this interesting trade where people leaving cities, they've bought cars, they've bought houses, and for the most part, their credit looks good. They've gotten low rates to do so. Is there any risk that a slower than expected employment? I mean, what are the risks to that trade, or is this a really interesting opportunity to kind of bet on the consumer right now and their credit stability?
Sure, I would say consumers are in a much better position this time of the cycle. If you compare it to the global financial crisis, they have a lot of savings because of the generous stimulus package. And we have observed that the lower tier of the consumer actually recovered their spending better than the higher tier consumer, because most of the spending that higher tier consumer that are used to are disrupted by the lockdown, whereas the lower tier consumer, their spending is more concentrated on the necessities. So the moment we have real reopening, I think the higher tier will release their savings, and that should boost the consumption. But so coming back to the subprime auto, I think subprime loans has higher priority for consumers to pay back their loans because they have to go somewhere. So as a result, this migration from urban to suburban will benefit the subprime loans so well. And especially when you see the old car prices, they have been doing extremely well. So that shows you the recovery rate for those subprime auto loans will be very high compared to the old time period of the financial crisis. So all those factors, they should bode well for subprime auto. And as an investor, you should go look at double B and single B of the top tier issuer. I think they are very attractive.
Okay. Tracy, thanks for the details, like the specific talk here on where you see these opportunities right now. Appreciate the update as always.
Thank you. Thank you.
Thanks a lot. Tracy Chen is portfolio manager and head of structured credit at Brandywine Global.